we ask everybody for their trade ideas, and yes, there was a few around that were kind of in line with where a lot of people are thinking. But what was interesting is there was very few big macro calls. A lot of people were looking at specific sectors like shipping or whatever, and that tells you that people, even that group, which is there's some pretty well-known hedge fund managers and big family offices and asset managers, aren't exactly sure what to think. Now, I've had a very strong view for a while, which was that liquidity was everything, and I wrote all of this up in that everything code that I've talked a bit about. That interview with Nathaniel Whittingmore, I went through quite a lot of what the everything code is, but that's still kind of exclusive to GMI. But liquidity is everything. All of my forward-looking indicators have been suggesting that liquidity is going to keep rising, and that it would drive crypto and tech more than anything else. And that's basically been the story of the year so far. And I think that continues. And that's confused a lot of people. The one trade that's confused me is the bond trade, and that's confused a lot of people. Bond yields should have fallen by now, and they still haven't. But I think this is to do with the debt ceiling issue, which is the other confusing thing. Because the debt ceiling issue has some real risks around it, and we don't really know how to price them. All we do know is people are pretty bearish around it. And I think that's reasonable too, to have hedged around it, because we don't know what can happen. But the chances are that anything that causes a paralysis of financial markets will lead to that expression I always use, more cowbell, more stimulus to come. So I'm going to run through a couple of charts very quickly, just to show some of the things that are on my radar screen so people can think about. So I'm going to start with my liquidity index. So this is the Global Macro Investor Weekly Liquidity Index. That's basically around the G5 central bank balance sheets. That we have our Financial Conditions Index, which is based around the dollar rates and a whole bunch of other stuff, which leads this, as does ISM. And it suggests that liquidity is going to keep rising all the way through this year. And the everything code suggests it actually keeps rising all the way through till the end of 2025. So yes, we might have some stumbling blocks. Yes, we might have some hurdles, but liquidity going forwards, as the economy slows down and the central banks start increasing their activity, that will drive asset prices higher. So that's the first chart I wanted to show you. So that's the liquidity chart. Why liquidity matters is this chart. This is the chart of the NASDAQ against that same liquidity index. That's the tightest correlation I've ever seen, and it explains 97.5% of all the movements in the NASDAQ is liquidity. And this is around this currency debasement idea. The more the central banks print, the more you're changing the denominator, not the actual value of the asset themselves. So again, the only assets that have really gone up in balance sheet terms are technology, the NASDAQ, and other like the exponential age stocks, and crypto. Also, actually, interesting enough, so is luxury goods. There's a reason Bernard Arnault is the richest man in the world, is because what does he sell? He sells scarcity, right? In a world where you're devaluing the denominator, scarce things go up more in price. So Bernard Arnault's balance sheet, his bank account goes up every week. So that's another chart for you to show. And then we can look at this, which is the chart of speculative positioning. Let me change that one and change to this one now. This is speculative positioning in the S&P 500. I have literally never seen anything like it. So the market is insanely bearish, which is why the NASDAQ's up 1.8% today, because people just don't want to believe it. They're angry. They want the market to go down. They want their bear market and they want their justice, and it's not happening. And the reason being is everybody's ridiculously, ludicrously short. On the flip side of the equation, we're going into this, and that's obviously driven by the debt ceiling. The other side of the debt ceiling is this chart, which is the speculative positioning in bonds. Now, bonds, as I mentioned before, have not been playing ball. I thought yields should be falling, but they haven't yet. But look what's going on here. This is the largest speculative short positioning in the history of the bond market. So if anything changes at the margin here, we're going to see a gigantic rally in bonds, which I'm still expecting, but this whole debt ceiling dynamic is getting in the way. Inflation dynamics on the other hand, are falling very fast. Things like the Truflation Index, which is a real-time calculation on chain of millions of prices, suggests that US CPI as of today is 2.2%, 3.2%. I think it still goes to zero by June or July, which Alex Gurevich has been talking about both on Real Vision and also on Twitter as well. We're very in a small camp of that. We're also seeing wage growth coming down. We're seeing rents and wages are the most lagging of all. So they're all still to come down. So generally speaking, economy slowing. We've got this whole debt ceiling stuff that's getting people very nervous. The resolution of that, one way or the other, ends up being ongoing liquidity as the economy slows. The banking issues have slowed down for the time being, but doesn't mean it's gone away. These things tend to come in phases. And so technology and crypto tend to outperform. Crypto's been consolidating for a while, but it's still up 50, 60% on the year, still the best performing asset. But again, it's likely to pick up as liquidity comes forward, as shown by our forward-looking liquidity indicators. And we've probably got 20 or 30 different things we could show you to say that liquidity is going up. So I remain massively bullish. There will be a correction at some point in all of this. As people start throwing in the towel on the short positions, then we might get a correction before we continue to move higher later on in the summer. So overall, super bullish. The only one that's puzzling me is the bond market still hasn't played ball, but I think we need to get through this debt ceiling thing, and then a lot of hedges get unwound.